First of all, I think the risk reward is extremely compelling at these levels. So roughly 5 to 10% downside versus a roughly 30 to 40% upside for the stock. Listen, I think investors have been somewhat disenchanted by the guidance for 2019, caused a significant margin pressure. There's been the public headlines about the data breaches. There's been the regulatory pressures. So I think all of that has weakened investor confidence in the stock. Rightfully so. But I think Facebook comes out of this in better fundamental shape. And I think investors who are willing to stick around with Zuckerberg as well as with Sheryl Sandberg, she doesn't get as much credit, I think they'll be rewarded because I think the risk reward is extremely compelling. You have Instagram is working really well. You have under-monetized assets with WhatsApp as well as Messenger. And you have the core Facebook platform, which, quite honestly, the checks hasn't been as positive as they have been in the past. I'm quite honestly getting more positive feedback from advertisers for Twitter, believe it or not, than Facebook. But I think they still have 2 billion users. I don't think these users are going anywhere, quite honestly. And I think they'll come out of this in better fundamental shape. They need to fix the platform, get more users, build trust in the platform, and I think it'll work.
I want to dig into that comment you just made about Twitter a little bit more. But first, Brian, when it comes to Facebook, do you agree with that thesis?
Not at all. No, and I think that as somewhat negative as much of the investment community is becoming, it is nowhere near negative enough. Unfortunately, I think that there's still too much optimism about the potential market opportunity. I don't think that most of the investment community understands that the global advertising industry has a relatively fixed size, growing at a relatively modest rate. Digital advertising can only take so much share of that total. The money will not come magically from a multi-trillion-dollar marketing industry. It won't happen. That's the first thing. So you have deceleration on the top line. Cost pressures is, I don't think the company is necessarily aggressive enough in what it's communicated based on what it will need to do. It's plainly not doing enough to do what it has to do. I mean, the fact is the company is underinvesting in just basic things, like making sure that their ad products are complying with laws, making sure that they're actually partnering with data partners who aren't going to then violate their terms. There's so many different areas where they've underinvested. On top of that, just the basic content moderation. I don't think investors understand how many people it's going to take to make sure that they're not causing more chaos in more countries around the world. Nick Clegg, the hire this morning, obviously that should be positive, assuming he can actually influence the company at the top and they actually invest heavily enough. But these costs are not contemplated in what most investors are thinking about right now.
And sort of to that point right now, Victor, I mean, I think you mentioned that advertisers seem to be more positive about Twitter than Facebook. Do you think it's some of those concerns playing into that?
Well, first of all, I definitely want to say that they gave guidance for significant cost acceleration for 2019. So I think that addresses what Brian says, but he makes some valid points. So Twitter, we conduct checks. I think everyone does it, and the checks have been extremely positive for Twitter. ROIs have been better. Sales execution has been better for Twitter. I think ad relevance has been better. They could do a lot more with ad loads outside of the U.S. domestic timeline. So I think there's a lot of reasons to be optimistic about the future's Twitter's ability to generate advertising growth.
Brian, I just have a question on the FANG complex overall. I mean, they're so well owned. Who's the marginal buyer here over time? I've talked to a lot of hedge funds who suddenly are getting scared. A lot of the names are featured in their portfolios. They're underperforming again. They may be sellers. I'm just sort of curious as to what you think about when you think about flows in general to what has, of course, been one of the key performing parts of the overall market.
Sure. Well, I only cover Facebook and Alphabet of those names, but I think it's safe to say that there's been a lot of momentum trading driving the stocks up, and I think that they're going to react to momentum going the other way as well. So that's a bit of a risk. I mean, I'm less concerned about Google and Amazon. Sorry, Alphabet specifically. They just seem to be better run, for lack of a better characterization.